When is the right time to invest? If you've ever found yourself just staring at chaotic financial headlines, watching stocks absolutely roller coaster, or seeing crypto jump drastically in a matter of hours, you've probably felt that overwhelming pressure. It's literally the beginner investor's biggest anxiety, trying to perfectly time a volatile market. You sit there asking yourself, man, did I miss the boat? Is a crash coming tomorrow? Should I seriously be checking my phone at 3 a.m.? Honestly, that anxiety alone is enough to keep your cash sitting on the sidelines for years.
Welcome to The Explainer. Today we're zooming in on investing's simple path to wealth. Our goal here is to completely demystify investing for you. We're going to replace that fear, that emotional roller coaster, and all that constant guessing with a super simple, automated wealth-building system.
And we've got a clear game plan to get us there. We'll be walking through 1. The market timing trap. 2. Dollar cost averaging defined. 3. The math behind the magic. 4. DCA versus lump sum. 5. Surviving the market crashes. And finally, 6. Start your wealth strategy. Let's dive into Section 1, the market timing trap. Stop guessing, start building. So here's a quick reality check. Even the pros can't perfectly predict short-term market movements. It requires a massive psychological shift on our part, because when you're caught in the market timing trap, your brain basically agonizes over one single question. Is today the perfect time to buy? And that just breeds FOMO, the fear of missing out, when prices are flying high, and panic selling when things drop. But if you reframe that mindset to simply ask, wait, is today my scheduled investment day? Everything changes. By focusing on a set schedule instead of hunting for the absolute perfect price, you take the emotional pressure off entirely. You're no longer guessing. You are in the driver's seat.
Moving on to Section 2, dollar cost averaging defined, your shield against volatility.
The whole concept really hinges on this, dollar cost averaging, or DCA for short. It's an investment strategy where you invest a fixed amount of money at regular intervals, completely regardless of whether the price is climbing or tanking. You could be throwing in $25 a week or maybe $500 a month. It truly doesn't matter what the market is doing that specific day or what the talking heads on the news are screaming about. The only thing that actually matters is that you stick to your predetermined schedule. All right, Section 3, the math behind the magic. Let the numbers work for you. Let's look at how this works in the real world. Meet our hypothetical investor, Sarah. Sarah wants to get into the market, but she only has about $200 a month to spare. Now, instead of waiting around until she somehow saves up a massive pile of cash, she decides to just automatically invest that $200 on the first day of every single month. She's not obsessively checking the market. She's not worrying about a looming crash. She just blindly follows her system. And the result? Over 10 years, just doing $200 a month, Sarah accumulates a staggering $24,000 in pure contributions alone. And keep in mind, that's literally just her own cash going in. Actual investment gains over that decade could make the final account value significantly higher than that. But, the money itself is really only half the story here. The real victory for Sarah is that she built an incredibly solid investing habit. Instead of waiting until she felt quote-unquote wealthy enough to finally start, she used consistent investing as the actual tool to build that wealth. It's a total paradigm shift. Let's break down how this builds month to month with a slightly different example. Say you're investing $100 every single month. In January, the price is $10, right? So your $100 buys you 10 units. But look at that aha moment in March. The market totally drops, and the price falls to $5. Now, a market timer is probably panicking and selling, but our DCA investor, they just put in their scheduled $100, business as usual. And because the price is lower, that exact same $100 buys a full 20 units. Then when the price shoots way up to $20 in May, their $100 naturally only buys 5 units. By committing to a fixed dollar amount instead of a fixed number of shares, lower prices automatically mean your money scoops up more of the investment. It's kind of brilliant. Now check out the massive visual punch of long-term compound growth. If you manage to invest $500 a month over 30 years, you'll have personally chipped in $180,000 out of pocket. But if those contributions earned a hypothetical average return of 8% annually, that portfolio could potentially balloon to roughly $745,000. Time, consistency, and compounding are just an absolute powerhouse combination. Let's jump to Section 4, DCA versus lump sum. Choosing your entry strategy. So what if you actually do have a pile of cash sitting around, maybe a year-end bonus or an inheritance? Well, you've got two main options here.
Lump sum investing means taking your, let's say, $12,000 and dropping the whole shebang right into the market today. Now, historically, since markets generally rise over the long haul, getting all your money to work as early as possible often performs the best. But emotionally, oh man, it can be agonizing. If the market tanks tomorrow, you are definitely going to be kicking yourself. That is exactly where DCA steps in as an awesome alternative. You could take that same $12,000 and slice it into smaller chunks, say investing $1,000 a month for a year. You're still putting the exact same amount to work, but you're spreading it out to completely neutralize that intense emotional pressure of accidentally picking the wrong day to jump in. Which brings us to Section 5, surviving the market crashes. Stay in the course when fear sets in. When the market abruptly drops 25% and your whole portfolio is just flashing red, your absolute first instinct is going to be to stop investing. But as we just saw, stopping totally ruins the strategy. Now, some folks confuse dollar cost averaging with buying the dip. Buying the dip is when you actively try to scrape together extra cash to throw into the market specifically because the price fell. True DCA, on the other hand, means you just stick to the schedule. You don't hit pause when things get scary, and you don't necessarily scramble to find extra money just because there was a drop. You just stay relentlessly consistent.
But hey, I do have to give you a pretty massive warning here. You always have to ask yourself, has the long-term investment thesis actually changed, or is it just the market price that's changed? Look, DCA is not some magic wand that's going to turn a fundamentally failing company or a dying crypto project into a sudden winner. If a price is dropping straight to zero because the asset is essentially garbage, blindly buying more of it on a schedule is a really, really terrible idea. You still have to do your homework and choose quality investments, whether that's diversified ETFs, solid blue chip stocks, or major cryptocurrencies. All right, Section 6, start your wealth strategy, the final blueprint. Before we lock in this habit, let's just rapid fire through the common mistakes you absolutely need to avoid so you don't fall into any rookie traps. First up, do not invest your rent or your grocery money. If you're going to need that cash soon, just keep it safe in the bank. Next, never invest blindly without researching what you're actually buying. Third, do not stop your scheduled payments just because the market is having a bad week. Also, don't randomly crank up your contributions just because a certain stock is trending online and you're feeling a bit of FOMO. Make sure you don't ignore diversification. Don't bet your entire life savings on one single asset. And finally, please never assume DCA guarantees a profit. Remember, investments can and do lose value. Okay. Here are the 4 exact steps to set up your personal DCA strategy today. Step 1. Budget what you can comfortably afford. Seriously, even if it's just $25 a week, pick a number that won't ruin your ability to pay your living expenses. Step 2. Choose your investments carefully, whether that's broad market ETFs or individual solid stocks. Step 3. Set your schedule in stone. Maybe it's the first of every month or every single payday. And step 4, which is honestly the absolute key to the whole operation, automate the process. Log into your brokerage, set up that recurring transfer, and just let the software do the heavy lifting for you. Automation literally evicts emotion from the driver's seat. Ultimately, consistency can matter way more than trying to perfectly predict what the market is going to do tomorrow. It is not about being the smartest person in the room who miraculously times the absolute rock bottom of a crash. It's about building a reliable, totally emotion-free system that just quietly puts your money to work month after month, year after year. So my final question for you is this. Are you ready to stop guessing at the market and finally trust a simple system to build your future?